Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, is expectations matter, right? How you enter a trade, what expectations you have for that trade will likely determine whether or not that's a good trade to take, whether or not that trade is successful or a failure. And what I mean by expectations simply is you can't go into a trade on a 1-minute chart and expect to get a 5-to-1 reward to risk. That's not likely going to happen. That's not realistic. So your expectation was not in alignment with the type of pattern you were taking or the time frame in which you took it, right? And the same is true also. If you get into a trade on a 15-minute chart and you're going to use 15-minute pivots and you're like, well, I want to make 5R, that's cool, but I also want to protect all my money. Well, that's not a realistic expectation either, all right? So you have to understand what the chart is capable of, how much room there is on the chart, what type of management strategy that you're using for that specific trade. So expectation is a very, very big part of trading. I see so many traders out there get into a trade and I'm like, well, what's your target? Well, I don't really know. Or what's your expectation for the trade? I don't really know. And you're like, well, you look at the chart, it only has 1R. It only has 1-to-1 to go. So maybe your stop loss is 50 cents, the stock has 50 cents, but your target's $2. Well, how can you take a trade when it only has 50 cents of room, but your target's $2? So your expectation was not in alignment with the reality of the chart. So we're going to talk a lot about that today. We're also going to talk a little bit about the crazy, insane volatility in these markets. I'm not going to say it's nothing I've seen before because 2008 and 2009 was pretty crazy as well. But the level of volatility recently has just been off the charts, and you're going to see that today. So we're going to talk about the level of volatility in the markets, how you can better handle that volatility, as well as the expectations you have for trades. I know some of you are thinking, oh, that's kind of a boring topic. It's not. Expectations for your trades is one of the most important things that you need to understand as a trader, because if your expectation is not in alignment with the actual chart and time frame and management, you're not going to be a good trader. All right, guys, if you like these videos, help a brother out, man. Click that like button, hammer that subscribe button. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is expectations matter. I think sometimes you guys see these lectures and you judge a book by its cover. And you read the title and you're like, yeah, I'm not interested in that topic. Stick around. This is one of the more important things to do with trading. You're going to get into trading and sometimes not understand how important your mental approach and expectation is. And while this is not a psychology lecture, it's mainly a chart-based lecture, you have to understand that the approach you're taking, meaning the pattern you're using, the time frame in which you're using it, as well as the management that you're applying to it, have a dramatic impact on whether or not that trade is going to work or whether or not that trade actually meets your expectation. Okay? Example, you can't take a 1-minute 3-bar play and expect to get 5R out of it, especially if you're doing, say, bar by bar management. That's just not a realistic expectation for that time frame, that pattern, and that management approach. And people do this all of the time, okay? So it's just one of those things that if you don't understand putting this together in a systematic way to make sure that the expectation matches the actual approach, you're going to be a very frustrated trader and maybe eventually turn into a failed trader. All right, so we're going to talk about that today. We're also going to spend a little bit of time talking about the volatility in the markets lately. We're going to take a look at something that I brought up, maybe 2.5 years ago. A chart I brought up about 2.5 years ago, and I'm going to bring it back up and kind of look at it in relationship to where the markets are today. And we'll talk a little bit about that as well. So hold on one second here. Give me one sec. All right, let me take a look. Have video on time. All right, cool. I just want to double check. Everything looks good. All right. So let's continue. All right. But before we get into the lecture, what we have to always do before we do the lecture is what? When will the insanity stop? When will the insanity stop? This week's is, I don't know, it's not terrible. It's really not. I hope this person sees this and watches it so that I can reassure them. Lost half of my money, super depressed, and I feel like such a failure. Okay, that's reasonable. But then you read the first sentence. I'm a 20-year-old college student. You're 20 years old, my man. You're going to go through a lot of that in life. Okay, we're not even talking about stocks just yet. Okay, you're 20. You don't know your ass from a hole in the wall. You think you know everything, but you don't know as much as you think you know. Okay? You're going to make a lot of mistakes in life to the day you die. The only question is, what do you do with those mistakes? Well, let's read on. I'm a 20-year-old college student, started trading, that's an important word, trading stocks January in 2022 with $30,000, and now it's at 15. I've lost about half of my life savings, and I honestly feel miserable. Guys, what did we just get done talking about? About professional trading strategies? What did we just get done talking about? If this person took professional trading strategies, there's no way they'd be in this position. Because you'd never be in the position to lose $15,000 because the money management chapter wouldn't let you. So remember when I said it's a lot cheaper to take that course than to not take that course, but you just don't believe me because you're different, you're special. No, you're not. We're all the same. We all have the same thought processes. Some are a little more extreme, some are a little less extreme, but we have the general thought process. I'm going to get rich quick. I don't need much money and I don't need an education. I'll teach myself. Everyone says the same damn thing in everything they do, not just trading, in everything they do. All right? Just oddly enough, the 1% is the 1% because they're the 1%, right? $500K a year, 1% of people make that kind of money in America. Why? Because they do things differently. All right? Anyway, I've lost about half my life savings. I can't even comprehend that I've lost that much. Well, that's good. It hurts. That part is genuinely good because it hurts. If it didn't hurt, I'd be more concerned for you. All right? It's led to anxiety attacks, panic attacks, depressions. Well, here's the positive. Let me slow you down from your anxiety and your panic and your depression. You're 20 years old. If you're going to make a mistake in life, make it young. Don't make it at 55 or 65 or 75. Make it at 20 or 25 because you have a long time to make up for that mistake. Because I can promise you this, 99%, 98% of 20-year-olds would love to have 15 grand to their name. I didn't. I was lucky to have $50 to my name at 20 years old. So while you definitely made a stupid mistake and went from 30,000 to 15,000, most 20-year-olds would love to have 15 grand. They would love it. So look at the bright side, the positive side. You're ahead of the vast majority of 20-year-olds out there, okay? I'm thinking of taking all my money out since the market is going down anyway and just stop trading for a couple years. Well, you should definitely stop trading. You clearly don't have any money management rules. 100% you should stop trading. You don't have any money management rules, okay? So you don't deserve to be trading. Right? You're gambling. You're not actually trading. It's gambling in the guise of trading. It makes your gambling sound more official. Hey, Mom, I'm a trader. No, you're not. You're a gambler. Call it what it is. Remember we talked about objectivity, self-awareness, discipline, being honest with yourself, being able to look in the mirror and saying, no, I'm not a trader. I'm a gambler. This person isn't there yet. But yes, you should take your money out of the market. Regardless, it's really hard for me to do that because I had such high expectations for myself in the market, but I'm so done. This is your typical, I'm going to get rich quick person. Why did you have high expectations for yourself in the market? You're 20. You have no prior trading experience. What would lead you to believe that you're any good at this? You've never done it. What would lead you to believe that? Hey, I've never played foosball before. I'm going to go to the World Championships and I'm going to win the whole damn thing. And anything less, I'm going to have panic attacks and depression. This person has probably never invested before in their lives and they've probably never traded before. What makes you think that you should be good at this? You've never tried it. You see my point? Any advice? Yes, stop trading, get an education. And then return to the markets 3, 6, 9 months from now when you've actually learned something The first thing you need to learn is how much you don't know, because there's a lot, right? So anyway, I'm going to move on from this, but this is a real story. This is actually only 3 days old. This is literally 3 days old, okay? People do this every single day. I'm telling you guys, people do this every single day. All right. Read the chart. The chart tells you everything you need to know, but expectation matters. You can read the chart and have the wrong expectation. You can read the chart accurately and go, hey, this stock has $1.27 worth of room to the next pivot. That doesn't mean your management is conducive to that chart. So when you think about expectation before taking a trade, note I said before taking a trade, where is the void? How much void does it have? Does it have confirmation? Multiple time frames, market conditions, relative strength, relative weakness. These are all of the things you go through. And you're like, well, duh, Jared, we know this. Right. But what you're not asking yourself is, after you go through the pre-trade checklist, does your management meet those expectations that you have for this trade? Because there are good trades out there that your management doesn't align with your expectation. Make sense? So for example, was it yesterday or the day before, we talked about a 1R scalp in a trade because it didn't have a lot of room. Was it Netflix perhaps? I don't remember. I think it was. We talked about a 1R scalp because, well, my normal management of a 2R target was not in alignment with the actual void that Netflix had, with the actual average trading range that Netflix had. So we had to adjust my expectation or simply not take the trade. Okay? So you have to trade within your expectations even when there is a good trade out there. See, for example, what might be good to you might not be good to me, and vice versa. There are tons of trades out there that have 2R of trading space or void in them. But if you're looking for 5R, well, that might not have that room in it. So while it might be a very good trade for me, it may not be a good trade for you, and vice versa. So you need to really look at expectation. I think a lot of you go, yeah, I know that, Jared. No, you don't. I see people making this mistake all the time. All the time. So if your expectations don't match the chart or the trade, you will likely fail or stop out. And then you're going to send me an email and go, Jared, what happened? Well, yeah, it was a great pattern. But the average trading range had been exceeded. It's up 200% of its average trading range today. Doesn't matter how good the pattern is at that point, does it? Oh, shoot, I didn't look at that. Hey, Jared, what happened? Well, it went 1.5R, and then it pulled back and stopped you out. Why? Because it was at a double top resistance point. That's why. And it only had 1.5R worth of room. Now, if you're the type of trader that says, well, I'm going to go to break even after 1R, that might be an acceptable trade. But if you're a 2R all or nothing trader and the double top pivots at 1.5, that's a tough trade. Sure, it could go 2, but it very well may not. Do you see the difference in expectation? Same pattern, same amount of room, 2 different management approaches. One might be acceptable because they get to go to break even at 1R, and the other one may not because they're doing all or nothing. So when you think about expectation, there are really 3 things you need to think about. Your management has to match your expectation. Your personality has to match the expectation, and your timeline has to match the expectation. What do I mean by this? I saw somebody earlier today. It's just literally coincidence that this happened, okay? Somebody in the chat room today was in MRO, and the comment they made was, got to take 1R on MRO, guys, I have to leave. Well, generally speaking, MRO is not a super fast trading stock, right? Jeff's in KMI, not a fast trading stock. Well, if you know you only have 30 minutes left in the trading day, and you're not willing or wanting to set a bracket order, why would you take that trade? Well, I just hope it gets lucky. Maybe it'll just hit target really fast. Well, maybe it will. But what if after 30 minutes it's down half of an R and you sell it for a loss, and then it pivots and goes higher to your target, but you got out for a loss because you got into a trade that might need 2 hours, but you only have 30 minutes to trade? Well, the expectation on that 5-minute chart in which you took the trade doesn't match the reality of the chart. If you're on a 1 minute, maybe 30 minutes is enough. But if you're trading on a 5-minute, 30 minutes is not that much time, especially given the pattern. If it's a breakout or 3-bar play, it's a momentum trade, maybe 30 minutes is enough. But if it's a pullback or some type of wedge or something like that that takes longer to materialize, and you're on a 5 or a 15-minute chart, well, then 30 minutes isn't enough. So your timeline doesn't match the reality. So the expectations doesn't work there. Why take the trade? FOMO, that's why. FOMO. So this is a big time topic. This is not a little topic because you guys are doing this all the time. Now, if you're a bracket trader and you're going to set a bracket order and it's all or nothing, then who cares? Set the bracket order in MRO and leave. It's going to hit target or it's going to stop out. Come back later, check it at 345 and you're fine. But if you're not, maybe don't take it. So, a couple comments. This is the market yesterday. All right. What is the expectation here? 100% retracement? What's the expectation? So yesterday, I think it was yesterday, 2 days ago maybe, 2 days ago, the Qs gap up, right? Okay, gapped up to, I don't know, 277. Great. You see this pink line? This pink line's support. What's the expectation when you gap up that much, which is a pretty good size gap, and you pull back to support? And you do so down 2, 4, 6, 8, 9 bars, and the bar is a bottoming tail right at support. What happens? What's the expectation here? Talk to me. What's the expectation? Big gap up. We pull back 7, 8, 9 bars in a row on the 15-minute into support. Is the expectation we're just going to keep dropping? The expectation is a bounce. That's the absolute expectation. The only question is, what type of bounce are we expecting? Because if you said anything other than a bounce, you're not reading this chart right. Now, we can have a deep conversation about how much it should bounce, where it should bounce to, but we shouldn't be having a conversation on whether or not it should bounce. Does this make sense? So this isn't a conversation about bouncing or not bouncing. It's going to bounce. The question, though, is how much. The reason I'm commenting on this, guys, this is so important, all right? We see a gap up in the market, and it was a big one. I mean, what was this, like a 2.5%, 3% gap up? I mean, the Qs are $270. They closed at $270 and they gapped up to $277. It's a $7 move. So a $7 move, we do the math right, divided by what, 2.7? That's a, what, 2.5% gap up? 2.5% gap up, pulls back 100% into support. What should you be doing here? What should your thought process be? And I'm going to give you a hint before you answer. Hint. Okay? Don't just think about the Qs. What should you be thinking about? As the market slowly makes its way into 270, what should you be thinking? I'll give you a hint. Think about more than just the market. What should you be thinking about as you see this getting closer and closer and closer to 270? Talk to me. Thank you, Tiago. On everything you see. You should be looking at the stocks that are holding up. You know how you sit there and go, man, I'd like to go long on this relative strength stock, but the market's just too weak. Well, now you don't have that excuse anymore because the market is now in an area where it should bounce. And if you're looking at a stock that's holding up better than the market, now is your opportunity to justify going long on that. So you may have an idea that you're looking at. Maybe it's Apple. Maybe it's Tesla. Maybe it's ASML. I don't know. But maybe you're looking at something that's holding really well during this pullback, but you can't justify the long because the market's so weak. Well, now you're getting to a point where the market's likely going to pivot. In a range, you can't say this penny or that penny, but in this dollar range, going to pivot. So now we're looking for those stocks to get in them when the market puts in the bottoming tail at support at 270. And when this little buy setup starts to trigger, you might look at other stocks that are stronger than the market. Now, you could trade the market, get in at 270, stops. Oops, it's 2, not 1, right? My bad, somebody commented on that, all right? You might look at this and say, all right, I can trade this with a $1.25 stop. But I'm definitely not expecting a new high of the day. So if you want to actually trade the market, this is a great spot. The market held up all over here. It's giving you a bottoming tail. There is some increased volume on this bar right here. That's like ending bar type volume on this red bar right there, okay? And then you can get in at 270, and this went to about 273. It actually went $3, which is over 2R. This is professional trading. This is when your expectation meets reality. The expectation here is a bounce. Now, 50% would be a nice bounce. 100% is not likely going to happen. But a 50% bounce would take this back to like, I don't know, 274 perhaps, something like that. Well, it ends up going to like 270, 250, 273. Get you your 2R and you walk away. Or you just find another stock that has better strength than this. Extend it into supports a bounce. This is professional trading. This is a great area for a market to bounce, especially to how it got there. Let's move on. What's the expectation? Swing trade? Day trade? Both? Well, do what we always do. Let's start on the left. I should have marked the charts. I apologize. This is a daily chart on the left. All the way on the left is a daily chart. Okay? Now, we look at this, and professional trading strategies talks about range trading, right? We talk about sideways trend trading, right? We have uptrends, downtrends, sideways trends. Those are the 3 trends, all right? And within those trends, we have different stages, 1, 2, 3, and 4, correct? Okay. This is a sideways trending stock. Now, big picture, monthly, it's an uptrend. We can see the rising 200 period moving average, which we know it's in an uptrend. But lately, the last 2 or 3 months, it's been stuck between basically 50 and 70, roughly. Okay, it's a little higher, a little lower. What do we have here? We have a wide range green bar taking out this pivot. Relatively smooth pullback, but $70 is a problem for us. But the good news is we're $7 below it. $62.95 is where this 3-bar play triggers, and you have room to 70. Your stop loss, however, is $6. That's a problem. That's a problem because in no way, shape, or form, none, not 1%, not 5%, in no way, shape, or form am I expecting this to break $70. That's a double top. Stock got spanked both times. Now, if it continued to put in a higher low, right, higher low, and maybe a higher low, then maybe I'd expect 70 to be broken. But they didn't. It put in a higher low and then a lower low, right? So my point is $70 is a serious concern. So how do you handle this? Well, if you're the type of swing trader that goes to break even at 1R, I don't know if it's a good idea or not, but that's not the conversation. If you're the type of swing trader that goes to break even at 1R, perhaps you can justify this trade and just hope it breaks through 70, which is a very long shot. Long shot. So you have a choice. You either don't take the swing trade and you, pink line, drill down to a lower time frame to take advantage of this because the lower time frame has a much better risk to reward than the swing trade does. But you're still matching time frames. It still is a 3-bar play with $7 worth of room. So while the expectation, we're going to keep repeating this word, is that the swing trade isn't great because of risk to reward, the pattern is still good. So let's change the time frame so that perhaps our expectation can be in alignment with the trade. See what we're doing here? So while it is a 3-bar play on the daily, it's a tough swing. I'm going to drill down and I'm going to try to take advantage of the daily swing or the daily 3-bar play by getting in a lower time frame. In this particular case, it offers you a 15-minute 3-bar play. See it all the way to the right. I'm all the way to the right. It offers you a 15-minute 3-bar play. Okay. Get in, 63.65. But note, the stop loss isn't $6. It's $1.45. So guess what you get to do? There's 2 things you get to do here. You can either go over here, find a tighter stop, add back, and be done by the end of the day with the intraday trade. Or you can take the higher time frame trade, which technically triggers at the same time. Don't add. You have a $1.45 stop, and then what? Hold it overnight for a day or two. So technically, it actually becomes a partial swing trade. Because 63.65 up to 70, it's giving you $6.35 worth of room. Well, that's acceptable because I only have $1.45 on the stop loss. So the goal on the 15-minute, the expectation, would be to sell some of your position at the end of the day for a 1 or 2 hour gain, sell half your position. Now you've locked in some profits and maybe hold for a second day move. If you're not into that, that's fine. That's fine. Take it on the 5-minute chart over here, buy it at 63.50, put your stop at 62.25. It moves up $1.50. You get about 1 R on that move up. It pulls back. Guess what you do? You add right there and you tighten your stop. So now you're going to add at roughly 63.50. It's almost the exact same area, exact same, but your stop gets to be moved from 62.25 to like 62.75. And now you have a 75-cent stop loss. And the move to the back to the high of the day is 2-1. And now you can be done. Do you see how we looked at the exact same stock on 3 different time frames, but the different time frames allowed us to change our expectation and actually gain a trade from this? If you started and only looked at the daily, it's a tough trade. If you don't want to hold overnight, the 15 minutes a tough trade. If you do, it's not a bad trade. But if you actually go down to the 5, it's like, well, this makes a lot of sense now. I could actually take advantage of this daily 3-bar play because I'm using a 5-minute. So it's multiple time frame analysis that aligns or allows the expectation to work in our favor instead of against us like the daily. This is how expectation matters, okay? And that's how you have to look at these things, all right? So here's mRNA. Why am I bringing this up? Because this is a trade we actually took, and we actually got 1 R from it. It says right here, Jared, mRNA 137.50 by 134.50, 1 R scalp. Why? Why is this a 1 R scalp? Well, we can see on the 1 minute, the pattern's not in question. This is a beautiful pattern. We can see on the 2 minute, it's a 4-bar play. So we're not questioning the lower time frame pattern. We're good. How do I know my expectation is only 1 R? Because I'm looking at the daily, and there's a 50-period moving average right there. 141.78 is the 50-period moving average. Resistance is the red line, the double top. It's slightly above that. Maybe it's, 145, something like that. But the MA right there is 141.78. There it is. mRNA high of the day was 141.47, and it never touched it again. See it? This topping tail on the 1 minute over here, that's 141.47. Damn, 30 cents off of the 50 MA. We get in this at 137.50. Guys, what's 1 R? Talk to me. If it's a $3 stop loss, I just want to see if you're paying attention. It's an easy question. It's a snowball. What's 1 R then? If it's a $3 stop loss and we're in at 137.50, what's 1 R? Yeah, 140.50. Thankfully for me, I got a good fill on this and I was able to get out at 1 R. Right? Because technically speaking, it missed our target by 3 cents. Technically. Thankfully, I got filled very good on this. I got filled at 140.140. And I got out. But that's not the point of the slide. The point of the slide is expectation must be in alignment with the reality of the chart. So my 1 R scalp expectation is in alignment with the reality of this 50-period moving average, which is 141.78. My expectation was 141.50 in the range. It's just a scalp. And I'm going to treat it as such. And we were very fortunate. The very first 1 minute bar went like $3. Then it consolidated for 2 or 3 minutes, and then it basically reached our target, came all the way back down. This is matching not just time frames, but matching expectation. So, would a 2R all or nothing trader take this trade? Give me a yes or a no. Would a 2R all or nothing trader take this trade? Yes or no? Only one person feels confident? There we go. No, they shouldn't. Now, I understand, guys, okay? It's possible we break the 50 MA. It's possible. But I'm not interested in what happens 20% of the time. I'm interested in what happens 80% of the time. Anything's always possible. This thing could have gone to $200. I don't know. But the reality, the realistic area was the 50 MA. So we have to take that seriously. That's the 80% likelihood. So it's a 1R scalp. And we scalped it for 1R and we move on. This is what I mean by making sure your expectations match the chart. Okay? No, Josh, and that's okay. If you go to break even at 1R, that's okay. All right? But if you're an all or nothing trader at 2 or 3, it's probably not a good idea. All right? Now, try another one. 3-bar play on the SPY around 310. Not a lot of room, but could scalp it. 20 to 30 cent stop loss idea. I put this out there on StockTwits. Put this out for the whole world to see. Why? Why did I do this? Well, and I'm going to say it right here. This trade is not for everyone, but it's not the point. I knew the expectation before the trade triggered. So we have a SPY that gaps down, bounces off of support, breaks support a little at 307, but bounces off support, pulls back, puts in a higher low, bounces, consolidates, and a wide range bar comes in. Now, this could be a problem. Why? There's a lot of overlap here. I'm not saying you have to take it, but just for the purpose of the slide, bear with me. There's a lot of toad in a blender here. Red bar, green bar, red bar, green bar, red bar, green bar, right? So a lot of overlap, a lot of battling happening, tug of war, buyers, sellers, buyers, sellers. But this bar, wide range igniting bar, comes out of a consolidation and breaks this pivot. Then a narrow range resting bar comes in and gives you a 3-bar play from 310 up to about 310.50-ish, right? That's the room. And that has to be the area because it's a double top. I'm not expecting it to break this area, especially after a move from 306, 306.50 up to 310. Oh, again, I am not telling you should take this. I'm simply commenting on the expectation. If you choose to take this aggressive trade, the expectation has to be 310.50. And it says it. Not a lot of room, but could scalp 20 or 30 cents. Maybe 50 cents, okay? So again, it ends up working. This trade ended up working. It went 45 or 50 cents on a 20 or 30 cent stop loss. It almost went 2 to 1. Maybe it did go 2 to 1. But the expectation is the double top. Okay. Not all charts are super easy. All right. This is SI. Okay. And this is from a couple days ago also. So note, on SI, you have this 5-minute, goes lower. Beautiful little consolidation right there, right? I mean, it's really nice. The entry is right on this red bar at 60 and the stop is 62. Okay? This thing triggers, bounces back up, drops. And it works. It was a great trade. It really was. It went from 60 to like 54.50 or something like that. 55, whatever it was. Okay? Let's go drill down now. So let's say the daily looks good, and it was actually pretty good, except it was down quite a bit, right? It was down a lot. You get into 60. What's the expectation and thought process here? You have a green engulfing bar, a turnaround bar, potential trend-changing turnaround bar. Now, granted, is it a true turnaround bar? It's hard to say. Then we get a retest on the 1 minute after this green engulfing bar. Well, the expectation is higher prices. And guess what? It went higher. It absolutely went higher. But it didn't stop out. And then it ultimately went back down at like 10.20 and worked. Why am I bringing this one up? Does anybody know why I'm bringing this slide up? Any ideas at all why I even put this in? Why I bothered to put it in here? Not really, not sure, maybe. Because things don't always go your way. That's one reason. But the other reason I'm putting it in here, okay, is that this trade depends largely on your management. Think about what I'm saying. If you're an all or nothing trader, this double bottom retest means nothing to you. Sure, you're reading the chart, and the expectation you should be reading from the chart says higher prices. And if I was an all or nothing trader and I were in this stock and I saw the double bottom, I'd be deeply concerned that I'm going to stop out. This would be a I need to take a walk type trade. If you're a 2R all or nothing trader and I see the double bottom retest right here and I see it bouncing, I'm like, I'm going for a walk. I can't watch this because you know what? It's probably going to stop out. However, if you're a person who reads the charts and acts upon what you're reading, you're probably getting out of this. And it ultimately worked. Do you see where I'm going with that? It really depends on what your management approach is on whether or not you stuck with this trade. Because the chart is giving you information that suggests higher prices. And it did. It absolutely went higher. But if you put your stop at 62, it completely held the stop loss, and then it dropped $4 or $5. So expectation mattered quite a bit with regard to your management. One person's management doesn't let them touch it, and they walk away. Another person's management is discretionary or allows them to read the chart, and they're out. You're not always going to be right. That's why we have stop losses. And hopefully if a person got out of this, they got out at break even perhaps, right? I brought this up because not every chart makes it easy on us. There are times I read a chart and I'll say, guys, we're done. Guess what happened on AMD? It held our stop by 3 cents. And yes, I was right about needing the market, but I'm not going to lie to you. I took a third off of that thing just above break even because it wasn't looking good and the market was looking lower. I you know what? I can't even say. I was going to say I probably should have held on, but no, the market was looking lower. I probably should have gotten out. And then that thing goes 6R. It's very difficult sometimes to read the chart and not be disappointed later if it doesn't work out the way you thought it was going to work out. It's not that your expectation is wrong here. It just didn't fully stop out. It was headed on stopping out, but maybe the market tanked. Maybe something changed. Okay? Yeah, held break even by 1 cent, right? Okay. Now, move along. I want to talk about, I want to talk about a couple things. So, we'll address expectation briefly later, but for the most part, I want to talk about this insane environment that we're in, okay? I brought up these next two charts a while ago, as in a couple years ago. Well, you can see them, okay? So, the SPY daily chart from June 2018 to July 2019, okay? There are zero. This is a 1-year period, 13 months. 13 months. 0 2% gaps on the SPY. 0. Okay? There is 1.6% gap. Note, there are wide range days, but they weren't gaps. They weren't gaps. Okay? And what happened? After a big gap down, after a big red bar. Okay? Think about it. Big red bar, big gap down. Market goes lower early and leaves a big bottoming tail. This, ladies and gentlemen, goes back to expectation. The expectation after a $9 or $10 move in the market the previous day and a subsequent gap down of 1.6% almost always equals a bounce, especially when it happens at support. Don't worry, there's a method to my madness. This was traditionally an accurate statement. The expectation is higher prices. We initially moved lower in the markets, and you're looking to buy the bottom of the SPY and the Qs right here because we're going to bounce. And we did. That was pre-COVID. Hold on, we're not done. Now, same, okay? SPY chart from June 19 to July 20. So we started June 18 and went to July 19. Now we're going to go June 19 to July 20. I drew a line there for a reason. 1.5% gap down, that massive gap. Okay? 0.9% gap down, 1.7% gap down. Almost always they bounced. Not always, but almost always they bounced. Still 2% gaps. So basically, June of 18 all the way into February, March of 2020. 18 months, 2% gaps. Holy shit. What just happened? 11 2% plus gaps from February, March to June. Guys, I didn't even do this over the last 2 years because it would have taken me a month just to put in all the 2% gaps, 1.5% gaps. Think about what I just said. The market is different over the last 2.5 years. Since COVID hit and the Fed decided to put $2 or $3 trillion into the market, crazy insanity, the markets are different. We are in a time where the previous expectation for a gap up or down has changed. You see, now we can actually get 2% gaps down and the market goes another 2% down. Historically and traditionally, if you got a 3% gap down, you were bouncing almost always, 95% of the time. If you got a 2 or 3% gap down, you can buy the 1 minute high off the open and you're good. You're going up, and vice versa. Not anymore. Not anymore. This is why I'm bringing this up. Times have changed. Sure, will we get back to the old times again? At some point, we will. Another year or two, we will. But now, what used to be true 2-3 years ago with regard to volatility and expectation related to volatility has changed. This is 11 gaps in a 4 or 5 month period. In an 18-month period, there were 2% gaps. 0. In a 4-month period, there were 11. And again, this ends in June of 2020. Imagine if I did this all through 2020, all through 2021, and all through 2022. To get a 1 or 2% gap down, it's like it's Tuesday. It's nothing special anymore. Oh, it's just a Thursday. What's the point I'm telling you here? We have to be malleable as traders. I'm not saying rip up your trading plan. I'm not saying this. I'm saying we have to be flexible as traders. One of the things I have done as an example, I'm taking some off at 1R now because of volatility. The market's crazy all over the place. Instead of just going 2R all or nothing, I'm going to take half off at 1R and then wait for the back half to hit 2. Because a lot of trades are going 1.5R because of volatility. All right? It's crazy, Dave, because I wish I had the time to do it for the past 2 years. Because I bet you it's 50 to 100. I'm not joking with you. If there's 11 of these in 4 months, there's got to be 50 to 100 of them over the last 2.5 years. And yet there were 0 during the 18 months previous to this. It shows the sheer level. Also, another thing to look at, don't just look at the gap on this chart, guys. Look at the size of the bars. Look to the left over here. Look at all these little tiny bars. They're not tiny bars. Those are normal days. But they look tiny because we're comparing it to a market that hasn't seen this volatility since 08, 09. Look at the size of these bars. We had a $20 bar in the SPY like a few days ago or last week. It's crazy, right? Crazy. Did I change the number of trades I take per day? Yeah, I'm taking fewer trades in this environment. Of course, I should have taken more today. We talked about that. Note, this is me, my pre-market bias. This market is insane. That's what I wrote back then. Sometimes sitting on your hands is okay when you're not sure about the environment. I'm telling you guys this because expectations change in this environment. And the other challenge about this environment is you might look at an average trading range of a stock, and that average trading range is $3. say that's just normal for whatever, IBM, whatever. But now in this market, it might be $5, right? So your expectation of ATR has changed as well. So we have to readjust our approach sometimes. We might have to give stocks much more room with the stop loss because of the volatility. So it's just kind of just talking a little bit about how environments change, and if you're going to be a professional, how you need to change with it. I'm not telling you to rip up your plan. I'm simply saying, what are you seeing out there? And do we need to make some minor adjustments to better handle the environment that we're in? Okay? Now, this next slide, guys, is because I got a couple emails from people, and also during the Trading Challenge on Monday, somebody asked me. So that this has nothing to do with the lecture. Just bear with me on it. It'll be helpful to many of you. Just bear with me, okay? It has nothing to do with the lecture. Nothing, okay? Somebody asked me, bracket orders, okay? Do you use them, Jared? How do you use them, Jared? Do you set them, Jared? Blah, blah, blah. Now, I think I went over it a little bit yesterday, but I happened to take a screenshot. This is years old. I don't even know how old this is. It could be 5 or 10 years old for all I know, okay? But these are two different platforms. One is what I consider to be old school, traditional order entry on the right-hand side, but you can still set a bracket order. Okay, on the left-hand side is TradeStation. It's what I use now. So this is a short play on SGMO. Okay, it went to 1R, so I moved my stop to break even or a little below it. All right, and then I put my target down here. So this is a bracket order. Note, my target is in down here. My stop loss is in over here. Okay, there is Matthew, but people tend to be lazy and no one watches the videos anymore. Haha, wink, wink, kidding. Over here, while you can't see it like an Excel spreadsheet, you can still see the bracket order, right? You can still see BAC, all right? And you can see the stop price is 1666 and the exit price at target is 1672, okay? So the point I'm making is every trade you take should have a hard stop in it and it should have a target. If you're gonna walk away even for a minute, set a bracket order and walk away. Now, it doesn't matter. The stock's bracketed in. If my internet goes down, the bracket's already on the server at TradeStation. If my computer gets the blue screen of death, my order's already in. All right? If something crazy happens, order's in. If I need to take a walk, go to lunch, something happens, order's in. I don't have to worry about it now. I might take a little bit of slippage, but the order is in. I don't need you to tell you the story of somebody trading MF in 2008. I'm not going to tell you the story. Let's just say it hurt. Just leave it at that. Okay? So my point simply is always have a hard stop loss. Always use a bracket order if you're going to leave your desk. I would encourage you putting a bracket order in even if you stay at your desk because it allows you to scan for other stocks. Now you don't have to stare at it. You know the target's in, you know the stop is in. Go start scanning for more opportunity. You're a business person. Your job is to find more opportunity. Go find it. Okay? In TS, how do you maintain the bracket when you sell part of your trade? You can either start the trade, Kelly, with a a divided bracket. Like you can do 1 lot, 2 lots, or 3 lots. So if you had 1,000 shares, you could do 300, 300, 400, 350, 350, and I don't know what's it come up, 300 or whatever it comes up to. All right, you can start your order that way. Right there, it says bracket, right? Or you can cancel the bracket, sell some, and then replace the bracket, or just hit place OCO, and then just drag the bracket up and down. It's very, very easy, okay? So, fail better, be better. All right, we're going to wrap this up here in the next 5-10 minutes. Fail better, be better, okay? Oh, Damien remembers, okay? Exactly right, James. If I stare at it, I'm going to mess with it. Set it and forget it. I love it. Love the attitude. Things to consider. Most great traders keep it simple. Most great traders have a very specific daily routine. There's no gray area. It's like, hey, this is what I do, and when this happens, I take the trade, and if it doesn't happen, I don't. You've heard me say it before, and I say it frequently. Look for reasons not to take the trade. Don't look for reasons to take it. They should be obvious. Look for the little reasons not to take it. All right? And if you can't find any, take the trade. Okay? Most great traders keep their emotions in check. You know a good way to do this? Have a consequence system. Have an accountability partner that holds you accountable. Okay? Most great traders have a very big why. Ooh, this is a big one. Why are you doing this? What's your purpose? It's just like, I don't like my boss. That's not a big enough why. I want freedom, flexibility. Okay, now we're getting there. Maybe you need financial freedom. Maybe you want to pay for the kids' college. All those are great, but you need a genuine why down to the core. Something that springs you out of bed every morning like listening to Rocky. I'm serious. If your why isn't big enough, you will fail. And I'll tell you why. This is the most challenging thing you'll ever do. That's why. So if the why doesn't mean everything to you, if you are not all in on this, you're probably not going to work for you. It's that difficult of a business. Okay? Your why shouldn't be some passing nonchalant thing. Really, it shouldn't be. It should be like your core being why you're doing this. Okay? Most great traders are process-oriented, not outcome-oriented. This is another big one, guys. Look, you have no control over the outcome. None. You set the wheels in motion. Here is your pre-trade checklist. Okay, I'm going to do my gap scanning, my daily chart scanning before the market's open. I'm going to create my watch list. I'm going to dwindle the watch list down to a favorites list. Then, when the market opens, I'm going to continue to look at my favorites list, 5 ideas, 10 ideas, whatever. And then, I'm going to use my process, which is my pre-trade checklist, to find trades that meet my plan. And when they do, I take the trade, and the outcome is out of my control. Zero control over the outcome. I already made my bed, it's time to lay in it. You've heard that? You made your bed, it's time to lay in it? You already made your bed, you're in the trade. Lay in it. Deal with it. You did everything that you can do. Now it's up to the market. And I guarantee you, if you take this approach, if you have a big enough why and you're process-oriented, trade tracking spreadsheet, journaling all your trades, consequence system, accountability partner, no FOMO, no YOLO, no diamond hands. You go in and you do what you're supposed to do when you're supposed to do it. You will make money in this business. If you don't, you won't. Question is, do you have the discipline to do it? Most of you, honestly, again, I don't mean this as a rude comment, so please don't take it that way. Most of you guys are just hackers. You really are. You half-ass this business. You half-ass everything about it. You come in undercapitalized and overhyped with no education. You come in, you don't have a trading plan written down on paper. You don't use a trade tracking spreadsheet. You don't journal your trades. You don't have an accountability partner. And if you do it for a day or a week or a month and then you stop. This needs to be unconscious competence, like walking and breathing. You don't think about walking. You just get up out of your chair and do it. You don't think about breathing. I'm speaking to you right now and I'm breathing as I'm speaking and I'm not thinking about it. Trading needs to become that level of competence for you. Unconscious competence. Yes, it will take a while to get to that point. Okay? All great traders know it's just a game of odds. But those odds are over hundreds of trades, thousands of trades, not 1 or even 10. Guys, bad things can happen over 10 trades. I've had 5 and 10 trade losing streaks before. Sure you have too. Unmol has. It's about the odds over a series of trades. Accept the randomness of an individual outcome. That is a process-oriented person. The outcome will take care of itself. Okay? Unconscious confidence, that's probably what you have, Randy. Yes. Okay. Guys, this business is the best, worst thing you'll ever try. If you do it right and you put the time and effort in, it'll be the best thing that's ever happened in your life. If you come into this business with a big ego, I did this, mistake. If you come into this business with a big ego and you think you're better and you think you're different and you think you're going to get it quicker, like 3 to 6 months, this will be the most difficult, most frustrating, most angering thing you have ever tried in your life. Guaranteed. It's frustrating even for the people that do it right with the right attitude. Imagine the people that don't. Brutal. Just brutal. Okay? You're not going to hear it any straighter than I just gave it to you. You're never going to hear it straighter than that. Okay? If someone else is telling you different than what I just said, they're just trying to take your money or they're lying to you. This business is tough. Really tough. Okay? When the market goes against you, you hope that every day will be the last, and you lose more than you should had you not listened to hope, the hopium. And when the market goes your way, You become fearful that the next day will take away your profit and you get out too soon. The successful trader has to fight these two deep-seated instincts. You know, kind of a decent trader, Jesse Livermore. He was okay, right? He was kind of okay. Wink, wink. Guy's a baller. Guy's a stud. Back in his day, there wasn't too many people better. Exactly correct. Is your fear of loss stronger than your hope for gain? In most people, it is. The pain you experience when something bad happens is typically greater than the joy you feel when something good happens. They've done studies on this. It's statistically true. That's our human nature. But read that quote again and tell me it doesn't apply to you. I tell you right to this day, been doing this 18 years, it applies to me. To this day, it applies to me. The question is, how do you handle it? We all go through it, but we handle it in different ways. Okay? We handle it in different ways. All right? So, I hope that you guys enjoyed that lecture. I hope you learned a bit about expectations and how they are very important to your trading. Whether it's the time frame you're on, whether it's the management you use, whether it's using it to drill down to a lower time frame so the expectation can now be put into your favor versus against you. All right. I hope you also learned a little bit about the volatility in the markets and how we've had to change our expectations because of the extreme volatility. It will not last forever, but it'll probably be here for a little while longer. All right. So I hope you guys learned a bit about that. I hope it makes you a better trader. I'm Jared Wesley of Live Traders. We'll get back at it again next week.